You place your stop loss just above a recent high. The setup looks perfect. Then price spikes, hits your stop to the exact pip, and immediately drops 100 pips in your intended direction. This happens so often that many traders assume their broker is manipulating the feed, but the reality is strictly mechanical. The market algorithm is functioning exactly as designed. It is hunting for the necessary fuel to fill massive institutional positions. To execute a massive buy order, a major bank needs an equal amount of sell orders. They sweep retail sell stops below obvious lows. In the ICT methodology, these aren't support floors or resistance ceilings. They are actually buy-side and sell-side liquidity clusters. To trade alongside the smart money algorithm, you have to map out where these targets are. Today, we are walking through the ICT magnet versus fuel strategy so you can pinpoint exactly where the market is going and what it needs to consume to get there. Once you train your eye to see liquidity pools instead of structural barriers, you stop providing the fuel for institutional positions and start riding their momentum. Step 1 is identifying the draw on liquidity. We need to establish the broader narrative by locating the exact pools of money the algorithm is currently targeting. This chart shows a clean 4-hour time frame. Starting here strips away the intraday noise and exposes the overarching market trend. Now, scan the chart for engineered liquidity. Look for the textbook patterns retail traders are taught to trade, specifically equal highs or the exact previous day high. These benchmarks are high-probability targets for a very specific reason. They are the exact locations where traditional trading courses tell millions of retail traders to place their protective stops. Because so many stops are clustered there, the algorithm is drawn to that line like a magnet. It prioritizes clearing Mills orders regardless of what a momentum oscillator might be showing. Before taking a position, ask yourself who is trapped right now and where is the nearest pool of higher timeframe money. If you can't answer both questions, you are the one being trapped. Step 2 takes us to the lower timeframes. As price approaches that green magnet line you mapped on the 4-hour chart, drop down to a 1-minute or 5-minute view. Do not enter the moment price touches the line. The magnet has simply pulled price in. Now you must wait for the algorithm to consume the liquidity. This diagram shows the difference between a trap and a transition. On the left, price crosses the level using small grinding candles. That is a breakout showing continuation. On the right, price violently pokes above the line and immediately reverses. That violent action is a confirmed sweep. The price spikes above the magnet level, triggers the resting retail stops, and then quickly snaps back inside the previous range. The resulting long wick is the visual footprint of the event. It proves the institutional algorithm just consumed the fuel required for its position. Being able to quickly tell a rapid sweep from a grinding breakout is the single most important skill for keeping your capital safe during the institutional accumulation phase. Step 3 is the entry. We never try to guess the top of that wick. Instead, we wait for mathematical confirmation that smart money has taken control of the market. We confirm this by looking for displacement. This is a violent, high-energy price drop away from the swept level that clearly breaks a recent lower timeframe swing low. That break is your market structure shift. This displacement has to be fast enough to leave behind a fair value gap, or FVG. You identify this by finding the empty vertical space left between 3 consecutive rapid candles. Here is your strict execution rule. Place a sell limit order exactly at the top edge of this newly formed fair value gap. The market will typically retrace just enough to rebalance that gap and trigger your pending order, before aggressively expanding toward the opposing liquidity pool at the bottom of the range. By combining the higher timeframe magnet, the lower timeframe suite, and violent displacement, you build a fully objective, emotionless framework. You execute directly alongside the institutions. To review, map the higher timeframe magnet, wait patiently for the lower timeframe sweep, and secure your entry on a confirmed market structure shift. Here is your assignment. Spend your next 3 trading sessions solely marking the previous day high, the previous day low, and equal highs on your charts. Do not place a single trade. Just observe how the algorithm reacts to these specific levels. Let the market prove the strategy's validity to you before you put $1 of capital at risk. You can find a link in the description to download our free FXNX liquidity mapping checklist to guide your practice. We recommend backtesting these setups on the FXNX NX1 account to experience true 0.0 pip spread precision. Every time you open a chart, you have a choice. You can be the liquidity, or you can trade with the smart money.